Hi, welcome to Market in a Minute. How about those Hoosiers? Can you believe it? That team is so well coached. Congratulations to the Hoosiers. Very well deserved. So that landmass there, that is Greenland. I know, it's supposed to be white, right? Maybe that's yellow snow. I don't know, but that's Greenland. So we're focused on the tariffs because of Greenland and the yen carry trade. So those are the risks right in front of us now. We thought it was prudent to start hedging when the news came out that they were going to criminally investigate Powell for the overruns of that building, of the new Fed building. Maybe it's deserved, but kind of bizarre in our opinion. So we've now broken some important moving average on the S&P. We're negative on the year for the S&P a little bit. So we think it's prudent to be cautious here. Big biotech update for you, okay? First day at the conference out in San Francisco, I walked up and down those darn stairs so many times, I can't tell you. But in total, walking around the city for meetings, I walked 8 miles that day. You know, I walk a lot, but that was a lot to walk at a conference. So disclosures, I'll let you read those in your spare time. As you know, all investments involve risk and are not guaranteed. Update. So the market update. We want to reiterate our view that this could be a volatile year. Like last year, we could see, a 20% decline like we saw last year. From high to low, 20% decline last year. Everybody forgets about that. So we think that could be volatility. There could be volatility in that, what we plan to do is pick off that volatility when it hits really hard. Pick it off to get more aggressive and catch it on a rebound. So I'm a tactical manager. I like to buy low, sell high. The earnings expectations for this year, just to reiterate from our prior videos, that the expectations are high, 15% growth for the S&P, 29 sector. So expectations don't leave a lot of room for disappointment here, with the valuations being high. And then the S&P 500 is up 3 years in a row by double digits. Hard to do 4 years in a row. We think it makes sense to be conservatively positioned at this point. So we've got some hedges in the portfolio as the 10-year Treasury rises. These geopolitical risks start to heighten. We think it's just Trump being Trump and how he negotiates, but it could get worse. So it makes sense to protect the portfolio as the markets could drop. As they broke through. Okay, here's the SP over here. Broke through the 20-day, which is a little disturbing, not a lot. Broke through the 50-day. We like the 50-day as an indicator, and it's not far from the 100-day. So you're seeing a slowing in the market's momentum. The 100-day not too far down below. So generally, we like to buy it like through here, like that big decline that happened in April, as it comes back above, breaking through these moving averages. So we could see more downside like we did last year. It's just a cautionary note. We're still very positive on the overall kind of macro fundamentals, where you got the Fed cutting rates, right? We think we're going to see more of that this year as inflation drops quite a bit. We see housing prices, existing homes, coming down. So that's going to be a big benefit to inflation, plus gasoline prices or energy prices coming down as well. So we don't see inflation as a problem. And then we get the benefit of all this fiscal stimulus that Trump's put in place. So all those tax cuts. So we got that going for us as a double-barrel gun that will keep this market probably doing okay, but we're going to have some volatility. The Japanese yen. I know you don't remember this, right? So we had this yen carry trade problem last year, early part of the year. So you can see how low the yen got. So this is dollar to yen. So when it's high like this, the yen is down. So it got to the point where the Bank of Japan had to come in and intervene and bring the yen back up in price. And so you had this large decline here in the dollar yen ratio. And it's back up here again. So we think that the Bank of Japan will have to come in and force that yen back up again. So when this happened, it really kills the carry trade. So the carry trade is when investors short the yen and they buy other assets with it. So when the yen's going up, it really hurts them. So when the Bank of Japan comes in to intervene, then it really hurts that yen carry trade and it causes dislocations in the overall global markets. Now, the biotech update. So we're all over San Francisco. Some of the themes that hit us was that in some of our meetings with these management teams, that the FDA is being more cooperative. They're taking a proactive approach. They've targeted some drugs to get them approved. We hope they're targeting Anavex. Certainly seems like that's occurring. So they want an Alzheimer's drug approved. But there's other drugs that they are being very friendly to get those drugs approved. And I think in particular the rare diseases. So that means diseases that have less than 200,000 potential patients in the United States. So there's no question at all, that the large drug companies are going to be very active on making acquisitions to refill their pipelines as these mega drugs come off patent as we go through this decade. So that's a nice win at their backs. Now, we went out to the conferences. So there's multiple conferences going on all around the city, lots of meetings. Got to meet, or got to see some of the analysts I like a lot at some of the parties after the meetings occurred. That was really good. But we went out there to see the pancreatic cancer area, hot area. We think we found a big winner there. The cardio area and the kidney space. So IMRX, that's the symbol of this company. They have a phase 3, they're going to enter phase 3 for a pancreatic cancer drug that looks like a winner. Okay, that's the only thing they got. So if it doesn't hit, this is a 0. But if IMRX hits, this is a 30 banger or more. This could be a really big winner. So there's some timelines to think about. They're going to have some more phase 2 data in the middle part of the year. Then they're going to crank up that phase 3, and that may take them 2 years to get through. But that phase 2 data, more phase 2 data, I think very strongly that data will look really positive, and the stock will be much higher. Mineralis, MYLS. So they have a kidney drug and a really good drug, and I'm sorry, Mineralis has a hypertension drug. So we like this drug. They very positive results for this drug. Lowers the blood pressure by 17%, 17 points. Big. So this will be kind of a best-in-class drug. We think it ultimately gets acquired for a very significant price. Maybe as much as 4x from where it is currently trading. And in the kidney area, Calcimimetica. This is something we own. I think our cost basis right now is about $2 and change. It's at $5.50 or so. We think that this is one of the cheapest in the space, or the cheapest in the space, given the high quality of that drug. So we saw a lot of kidney companies out there. We liked a lot of them, but I think this is really compelling value. CALC. Spruce. Okay, this is in the rare disease space. This drug will probably get approved sometime in early 2027. Big potential. Butterfly. So this is kind of Star Trek sort of technology. You remember that series back in the 1960s? They have a chip that can MRI your entire body. So it could find out, if you're in an emergency room, it can find out where the problem is without having these long diagnoses and run you up to the MRI room or taking x-rays. It can find the issue very quickly. So this replaces the analog sort of imaging that's currently done with different ones for different areas of your body. So this is kind of 3 or 4 years now, and coming out into the markets. They've got the latest generation. This is a really interesting company. It's kind of highly valued right now, but we like it a lot. Anavex and Veru, it was good to see those guys. We think that Anavex is having really good discussions with the FDA, and I think the FDA wants this drug on the market, but they have to find a way of doing it. Not sure if they're going to require phase 3 or whatever it may be. Maybe it'll be a conditional approval, but we think that they're kind of working through things with the FDA. That could be a very positive event. And then Veru, good to see those guys as well. This has been, a horrible stock, but we think that they found a way of getting this drug across the finish line. They're going back to do a phase 2, and then to do a phase 3, a bigger phase 3, but to sell the company at that point. So it's nice to them to think about realizing the value of this drug, but they're just going to take them, a reasonable amount of time to get to phase 2, nothing inordinate. And then what this drug does, it increases your muscle mass or preserves it. If you're on a GLP-1 drug, and when you come off GLP-1 drugs, you gain all the, all your weight back, but it's all fat. So this is a nice way of rescuing you off that GLP-1 drug. And then, they're going to have another indication. So increase muscle mass, incremental weight loss, and then to increase bone density. So that's very important in the elderly as they lose weight. So again, really undervalued drug or company. So we see the potential to have one of these super cycles. So this back in 2009 into middle of 2015, there was nearly a 500% return in the biotech space. You can see the volatility. Big returns, okay, you gave away almost half, doubled your money, gave away about 30%, doubled your money again. So if you held it through here, you would have made some nice money. If you could have protected yourself, you would have made even bigger money, right? So down almost 60% from the highs in 2001 to the bottom, where we were pounding the table on this, if you remember, pounding the table on it. And then you've got roughly an 89% return off that bottom. We don't think that's it. We think it's going to new highs because of what we're seeing. A cooperative FDA, large drug companies needing to buy these companies. Lots of things in the pipeline. Lots of drugs in very important areas of the markets. So we think this could be a multiple year move. I'm not sure it's going to do 500%, but multiple year move. And you just have to watch the volatility or be able to deal with the volatility. So as you know, this is an area we specialize in, and we've got a lot of really good ideas here. We got strategies that have really strong performance, and I encourage you to come to the PVG website. You could check that out to see how we've been doing over the years. But currently we're in a let's not lose money early in the year. Let's not go down 5 or 10 or 20%. Let's protect ourselves if this market continues to roll over. As you know, we hate to lose money, so we don't want to lose money through this early start and have to try to make that back up as we go through the year. But we think that the year will probably end up higher. Not sure exactly to what extent, but if we can clip off the bottom here as it pulls back, we can get some really nice returns. This could be a really good environment for tactical strategies like this. And then we think that the environment is really good for biotech as well. And we think that the rotation, maybe it's on hold here if the 10-year Treasury doesn't hold, but we think that rotation continues as we go through 2026 and into 2027. Thank you very much. Please hit like and come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute, And then if you're interested, come to my place of employment, PBG Asset Management. You can check out some of our strategies there. Take care.